Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, May 31st, 2023, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader ViperXL007, and we are going to take a look at a couple of different topics here. The first one is AI, artificial intelligence, AI. If you've listened to very many earnings calls as of recently, or picked up the paper, or really read any articles online, you probably saw those two letters of AI, which will also lead into the next two topics. I put on an earnings play today in CRMs, that's Salesforce, and we're going to kind of review that play. Additionally, I have a future upcoming play that I've been scoping out of SMCI, that's super micro, and those are the topics that we are going to hit on this week's episode. But before we hop to those, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. We love to hear what you're trading, love to hear what type of content you want to hear about. You can also go to theta-burning.com/sprocket888, where you'll find each and every one of my trades, the good, the bad, and the ugly. Lastly, this episode is available wherever you get your podcasts. Go pick it up there, and if you can't find it, let us know and we will get it there. But let's hop to this week's content. Viper, this AI, man, I think it's reaching the cloudy cloud of several years ago. And it's been a buzzword that's been out there, but this past week, nVidia had their earnings and just like kicked all of the talking heads into uber hyper gear for artificial intelligence and AI. They came out with earnings, I mean, just absolutely smashed all of their forecasts and guidance and analyst expectations. And the crazy thing is they had already redid their guidance like a month earlier as far as what the revenue was going to be for the quarter. And I believe that the day after their earnings was either the largest or the second largest single day gain of any S&P stock ever, with nVidia rocking like 30% jump for a mega cap. And that just set on this, any company that uttered the words AI since then has just caught fire. Have you picked up and noticed much of this?
Yeah. I mean, I feel like, like you said, cloud from a few years ago. More recently, anybody remember the metaverse? Everybody was, metaverse was in every earnings report. Everybody was building a metaverse, and some people were renaming their companies after it. And then, right now, AI, it's the same thing all over again. It's kind of like, and I don't want to say all that to, diminish or minimize the impact of all three of those things: cloud, metaverse, broadly speaking as metaverse, not as Meta, the company, and AI. Like, these are all three very real things. And, the easiest for people to understand will be cloud. So we'll save the metaverse for some other episode, but cloud is an easy thing now that we have so much hindsight on it, that it's real, and there are very real gains to be had from very specific companies. And I think AI is the same thing, but it also feels like at this exact moment, it feels like when, I don't know, the star pupil in the class did something good on the test and everybody started copying the test, and they just walked into their earnings calls with that copied piece of paper of, oh yeah, we're doing that too. But it is very real. Like you said, for nVidia, it's very real for a handful of providers, I would say, on the hardware side. Obviously, you have IBM, AMD, nVidia, Intel, you got all those big names. And I think it's very real for them. However, hype tends to overbuy. So we'll see we'll see where that goes. But that's not to say, like, I guess the point I'm trying to make is it's not a fad per se as a technology, but it is a lot of hype right now for sure.
Yeah, no, I totally get that. And I kind of back that opinion. In fact, you'll see when I talk about some of these upcoming plays, most notably SMCI, which is super micro. They're like a computer chassis manufacturer. They make a lot of cases and things like that. I think AI, this is my personal opinion here, that AI is probably one of those technologies that I don't want to equate it to the internet or one of those other super disruptive technologies, but it's probably not that far from it. Where, go back to the internet and look at that huge bubble that came up there with internet stocks. Everybody, we're on the internet, and then boom, 600% up. And it was a lot of that overbuying where there really was core value under there in the technology itself. And there was a lot of fluff and hype and snake oil and stuff out there. And I feel there's a similar parallel here to AI, where you're getting this explosion in stock price because everybody's hopping in the bandwagon. And I don't think it's vaporware in the fact that this is just going to go poof one day and everyone's going to be like, hey, remember those 3D TVs? Um, I think there probably is a long-lasting race here to be had, and I think there'll be players. So that goes into some of the plays where I kind of want to fade the up move, but I'm still kind of in the tech. So, it's not like I want to short it per se directly. At least my time frames are a little bit longer moves. And so it's not like a direct short. Plus, some of these things are really expensive to short, but kind of playing that both sides.
Yeah. And I mean, I don't know. It's an interesting time because I feel like, I agree completely, as far as disruptive technology, and then the snake oils and all that. And it's an interesting time because obviously anyone who's watched a lot of the show knows that, I'd say both of us, but certainly I am very crypto friendly from the same perspective of the focusing on the underlying tech and acknowledging the layers of junk and snake oil that's on top of it, which to me is interesting, just at a really high level that, is this a tech thing or do we only pay attention to tech things and it actually exists in other places that we just don't pay attention to?
Yeah, so we'll see how it shakes out. I mean, keep your eyes peeled out there for a lot of AI type plays. I guess not say type plays, but just be cognizant of the AI verbiage and kind of the overhype in the buying. And when we get to SMCA, I'll kind of bring SMCI. I'll bring it back up again. But let's hop to a play that I put on just today for CRM, which is Salesforce. And Salesforce is a customer relations management system. It's a piece of software. It's a piece of technology. And I actually had nothing to do with AI when I entered this play today. I was actually screening at the earlier part of this week, looking to deploy some fun money earnings. I love earnings because we've talked about it on the show before. It's one of those things where you roll the dice. You listen to the earnings call, you read the earnings report, and you know whether or not you're a winner or a loser or meh. And it's just a lot of fun to kind of do those. And so I'm trying to get back in them. And earnings season's really kind of coming to a close. I've played a few earnings so far in the season, and I wanted to squeeze one more in this week. And so I was looking for what was upcoming. A couple of them had jumped out to me, but I decided I wanted to go with CRM. And what I liked about CRM, and I'll show you the chart here, so let's flip over to the chart, is in CRM case, it is really, really ramping up. It's been on a bullish tear, shooting way up to 52-week highs. And the volatility was creeping back up. So my volatility is that Christmassy looking line chart there in the bottom. And you can see when it's green, it's basically in this, according to my algorithms, prime potential selling category time frame. And right here, we got this nice green pop where volatility was really rising into earnings to the point where it was in the 98th percentile. So just super rich premium. And what I also liked about this is it was a real bullish overall chart. And what I was kind of hoping for and looking for on the CRM trade was because this was so extended to the top side, that's really what's stretching the volatility because you're setting new all-time highs. Not all-time highs, new 52-week highs. It's been higher in the past. And that really increases the range that the price of the stock was in so that volatility gets higher. When the volatility is higher, you can set your strikes farther apart and still collect decent premium. And if you get disappointing earnings or something like that because there's so much momentum here to the upside, I feel there's more probability that one of these previous levels that we went through will catch and kind of gain you a little bit of traction where you're giving up the highs, but you're not really falling down to earth versus something that's already in a bearish swing. So it's a little bit of a buffer is how I view it. So I really liked this particular chart going into earnings. Now, before I visualize the actual move, and I'll pull up a chart for that, I want to go to the option chain because I want to show you kind of what I was looking at. Now, these are the various option strikes, and this first one are the ones that expire this Friday, the ones that expire next Friday, and then so on and so forth. But look at this volatility in these option chains. The ones that expire this Friday were 184% volatility. Going out just 1 week, that gets cut in half. And so this play is pure volatility contraction. I want to stay within those strikes. As soon as those earnings are out, that volatility is going to go gone, poof. So I went with the expiration of this week. And because there's so much volatility and because this underlying is a relatively higher valued underlying at, trading at $220 a share, I went to look at these strikes, and I typically start with a 20 delta. Now, this is the delta of the market close, but you can see on the put side, at close, it was, 230 on that side. But what was really cool is because this thing had so much skew to the call side, so much pressure moving up, this is really where I wanted to play it. I wanted to play it on the call side because the same delta, so this is a 24 delta on the call side, was gathering $5, $4.75 in premium for the same delta on the call side because the market sees more risk to the upside. So when you really get that call side skew on an overstretched all-time high, this is an area where I get a little bit more comfortable playing the naked call. Keep in mind, the naked call is like the most, I'll say, unsafe options trades that you can sell because there is no limit to your loss because stocks can go up to infinity. Is it likely? No. But as long as that stock keeps ripping, you will keep losing money if you are short the call. I was playing the probability here, call it, standing in front of a freight train. I don't know. But because this premium was so thick, I basically sold the top and the bottom side of this for $6.18 is what I collected. And the amount of risk or buying power that I had to put up was $3,400. And so that's a $620 return, if it works out, on $3,300 of buying power. So I told you I would switch over to the chart. And so let me just show you what this trade visually looks like. I put this on the hourly so you can see the actual earnings announcement come out. But yep, this end of this boxes here is when the option expires. This is hourly and it does include after hours. So basically this trade is going to be done by Friday. Now, I'm likely this thing will come off tomorrow because volatility will just absolutely crush on this. I'm only looking for that volatility crush. I'm going to cash out, take whatever profit I get from that, and I'm going to move on to my next trade. But you can see right here, we kind of crept up heading into after hours. So that last green candle right here, that was when the market was open. And this first red candle with this giant wick on the top and the bottom, that's when the earnings came out. You can see actually the earnings were super good. They were beat on the revenue. They were beat on the earnings per share. They were confirmed. They were beat on the guidance. They confirmed their full year. It was pretty much just an all around great story. But the stock sold off, which just goes to show you it's a coin flip. And so far we've kind of dropped. We hit a little bit of support here around 208, something like that. So 200 is my strike on the bottom. And then because I collected some premium, that yellow is where I'll still make money, just not 100% of my money. Red means I'm losing money, but you can see on that graphic right there that we are looking at hey diddle diddle right down the middle so far. And that it will just be a beautiful, beautiful play on open if we stay in that range where within the first hour that volatility will just get absolutely smashed. I might drop in, the final what it got crushed to, but I would expect a 50 to 70% reduction in that volatility within the first hour of trading.
So real quick, that massive candle, which is what I expect to be, oh yeah, we can see it there. That's the actual candle that the earnings happened. So the market was full reaction. What is the price range on that entire candle from wick to wick?
Looks like it's about $20, about 10%.
So the only reason I wanted to point that out was, I feel like that's the reason you do the deltas you do, and you get the strike farther away, because that's a wide spread.
Yeah, actually, if we just pull this up to where my spread is, I'm covering a 22% move here. That's just to full profit. If you want to see what's my coverage here down to break evens, where I could wash, you're looking at probably a 30%, $60 move in 3 days.
Yeah, and so that's not. I guess my main point in that is like if for anybody like getting into options, first of all, yeah, like you said, the naked call, that's the one that's the widowmaker that everybody fears, rightfully so. Naked puts as well, but I don't know, I feel like there's a little more control there. But that's, to anybody thinking about options or just getting into them, like that, there is at least for me, there is that mindset tease of like, okay, well, it's, this 20 delta is $4.80. But if I go to like 35 delta, like now it's like $6, and you start being like, well, what is it on the chart? Well, that's like it's a 10% move. And like you start to, trick yourself into being like, it's not that big of a deal. But that price swing there, it didn't have to come back to the middle kind of like it did. Like it swung both those directions, and it could have stayed there. And so, this, I guess, speaks to general options plays just as much as earnings, but that's, to me, where it becomes really important to be mindful of that delta strike, and when you're in higher risk territory, just how easily sometimes that can get hit.
Oh yeah. You can look at some of these deltas and how tempting some of these could look like when you pull in that delta and increase it. Keep in mind, delta is effectively a measure of risk, and you can see just coming into right here at 230, you're talking about collecting almost $1,000 at a 230 strike. One thing, Viper, that is just I thought hilariously crazy on this CRM trade that I put on, because this is so short-lived. It's really a 2-day trade. And remember, in previous episodes, I told you about how I target a particular daily theta, and I want to try to collect $75 in daily theta, and I want to try to always have $75 in portfolio theta on my trade. Because the law of working that through says I'm going to keep a certain percentage of that, and that daily theta is how much my portfolio is decaying every day in theta, and the decay in this case is not a bad thing. It's a good thing because it goes profit in my pocket, because I sold it, so I want the value to decay away. But just looking at the theta on that CRM trade, you can see it right here. In the center, there's 3 of them. This is at the zero value of where it's at. presently. This is a little skewed because this is now after the earnings. And so right now it has 482 theta, daily theta. When I actually put this trade on, it was around 330 theta, 320 theta, something like that per day. And that's basically because, remember, the option has to go to zero. So if I sold this spread for $6.50, $650, that is going to come off at 325 a day because it's only going to be around for 2 days. So that theta's got to come off at $325 a day. And so that's just crazy to see this one trade, which is hilarious because it's a delta neutral trade. So the delta, as we talked about in previous episodes, is your measure of risk, and the delta on this strangle was 0.15 because I went out both sides equidistant. And so it's kind of interesting to have that much theta where your risk is kind of zero. It's not practically, it's not zero because you know there's a binary event coming, but statistically when you put it on, you're just like on the uber side of benefit for you to collect versus directional risk. When I put it on, there was no directional risk when I put it on. So the tie-in here to AI, which is kind of really had nothing to do with setting up the play. Like I said, it was a pure earnings trade, but it was in a report after the bell today, and so I turned into the earnings announcement to see what did they say, how did it turn out, to see where the play was. So when you were seeing that big 10% candle up and down $20 move, they were kind of releasing their earnings, and it was real funny in the conference call. What's like the very first thing they said was, yes, we have released some new of our AI features, and they kept talking AI, and I'm just like, oh my goodness. Because they're really kind of touting their artificial intelligence and their customer relation platform, really doing the heavy lifting for you, the user. And I think they call it like their Einstein platform or something like that, which is, I don't know, AI. All right. So the next topic that I want to kind of touch on is this SMCI, which is super micro. And this one came up when I was searching for, hey, what type of things have high volatility, pretty decent price of the underlying to kind of pick up more of the theta, and what's out there, what's there. And SMCI really kind of hit my screener, and when I took a look at it, I couldn't believe how much knock-on effect nVidia had on this. So I'm just going to switch over here real quick just to show you the chart that I saw. This is a daily chart where you can see right here on 5/24, this is when nVidia had its earnings, and it gapped up huge after nVidia earnings. These guys make compute server chassis and stuff like that, so very directly tied to nVidia news, where an expansion in AI, chips, data centers, things like that, presumably will drive work from SMCI. The crazy thing is, if I switch this chart to a weekly chart, I mean, this thing is like going parabolic here. Just huge candles, huge ups, and it kind of switch back to the daily because that's where my chart comes up, and you can see we're ticking up here in some higher volatility, 91% IV percentile. So we're getting up there in some good IV rank of 65. This is where premium selling becomes interesting. Now, much like that trade on CRM, we're kind of at 52-week highs. Well, in this case, all-time highs, where you're really stretched, and that's really pulling that volatility and giving you this huge call skew. So the same call skew that I talked about with CRM, there's lots of premium for selling that call side. And kind of what I mentioned to Viper in the beginning of this episode, where I'm talking about, AI is kind of getting a little bit inflated, but it's got some good core underlying technology and implications under it, but it's a little bit overblown as far as the buy overbought. So SMCI kind of seems like the type of company that is providing the nuts, the bolts, the infrastructure, the oil of the engine, if you would, because they're a hardware equipment manufacturer. They're not a flu-fluey software platform. So they have real tangible things they're going to sell. And so this is one of these things where I kind of want to fade this pump, but I'm kind of okay taking the risk as well on the downside because I feel there's likely kind of catching of things when it comes to that. And so I decided to look at the option chain. And Viper, this might be a trade that you might want to also take. I put two of them here to get back into the premium selling side of things, but let's go ahead and hop over to the option chain. And so in this case, I don't want to go out short term, want to kind of come out longer. So 16 days is the first monthly. That's a little too short. I like the 35 to 45. July monthly is 51, but I thought, well, I'm not really putting this trade on right now because I want to use the capital from my CRM trade to place this one. So maybe in a couple of days, the July will be a good one to take. So I went ahead and looked at the July strikes here. And the one thing that I noticed was, look at this 20 delta, Viper. 20 delta, which is a 185 strike, is collecting probably $7.50 for that 20 delta. And if you come down here to the 20 delta on the call side, now the call skew has kind of come in a little bit on this, but again, you're still talking $7.50 or so on there. And so the trade that I put on, or that I didn't put it on yet, but I'm considering, is I actually want to come in real tight on the call side, which could be a little bit dangerous, right? Because it's a naked call, but there's quite a bit of premium there, and I just cannot fathom the sustainability long-term of this just giantly stretched up move. And so I set my strike at 270, which is actually a 30 delta. And when I play a directional play, I'll typically come up to a 30 delta, as high as a 35 delta. But in this case, because it's a call side, I wasn't quite ready to go to the 35 delta. So I took the 30 delta, which is going to collect close to $11 probably at that strike. And then I went and did the 185 or the 20 delta put, because I do think there is more likelihood that this thing is going to go lower. So I kind of wanted to give my space on the bottom. What I want to call out here, Viper, is that naked strangle is going to collect $24.45, putting up a buying power of just 4K. That is a ratio that I am interested in, giving me quite the range. If I flip this for what's expected by the time July, that gray is the expected move. But you can see my break even on the high side is almost $300. So, I mean, this thing's got to move $75 to the upside before I start getting crushed on the call side. And down to the downside is 160. And maybe you can take a look at some of the chart, but I just feel there's traction to catch this thing and hold this thing up on the upside and catch it on the downside. Now, the one that I want to call out for you, because to be honest, naked calls, strangles, that's not for beginners. But I went ahead and I kept those same strikes, the same short strikes, 270 and 185, and I bought protection legs. Okay, so I basically put an iron condor to limit the risk, and I went $10 wide. So went to 280. I bought the protection leg on the top end. 175. I bought the protection leg on the bottom end. This trade will put your max buying power at 1,000. There's no expansion. $1,000 is what you're going to put down on that, and you're going to collect $3.95. That is about a 40% potential return. And this is the trade that I think might be more interesting to those people that are defined risk, where you're really capturing this premium But you are kind of defining your risk, and you have the potential to turn 40% return on that capital.
That might be one I take a little closer look at because there's also, and this is we'll put our hard hats on and go into a little exploratory mode here if we take a look at my chart, because there's, so this is one area that and so that's why I preface, put our hard hats on. This is just purely experimental, but one thing that I'm now trying to get into getting comfortable with are these all-time high breakouts. When you have, especially a parabolic one, but in any case, any all-time high breakout, it's like, well, where does it stop? Kind of like you said. I mean, like you said there, like, I just can't fathom. Okay, well, I mean, that's bringing a lot of emotion into it. And I mean, I agree with you, but also there has to be something we can use to be a little more deterministic on it, or as deterministic as possible. It's probably offensive to use the word deterministic in this scenario, but one of those tools, and so I bring it up as a ping on the radar for more exploration on you, the viewer's part, because that's all I'm doing, is the Fibonacci extension, trend-based Fib extension, which is a tool intended to help guide these kind of moves, these kind of all-time high breakouts. And it's, I don't know the whole theory behind it, but it's obviously based along the theory of the Fibonacci sequence and how that, all the various ways that presents itself in nature. So I'll spare the theory that I don't know, and we'll just drop it down on here and see what we can get. And so by my understanding, as of this recording, you use the tool to chart the most recent all-time high run and retrace before it sprung into the current swing. So this is kind of, as far as I understand, this is a pretty textbook setup here. So we have down here, let me find my marker and be a little more clear. Down here was where we kind of had the start of the previous all-time high. So we had this run up, and then we had this retrace, and then we got support for the new all-time high. So that's the move I'm looking at, and I'm interested in to drop this Fib extension on. Let me clear this out. So let's grab our Fib extension, and all we're going to do is drop that same move. So you click here, you get the line, you mark the top of that previous run, and then we drop it down here to where that started, where the current run started, and we drop it. And so these are just the Fibonacci levels, the Fibonacci sequence, the levels of that sequence. And there's a lot of theory that I'm not going to speculate on. As far as I know, there's a lot of people that study like using this in equities versus crypto, and there's a slight difference of in equities, it's X number of levels is a reasonable expectation for an all-time high run, and then it's a slightly different number for crypto. But if we look at this, things are looking fairly interesting here because we can see right around the one, right around this level, we kind of hit it and stalled out, and then we ran and we tested and did a little stutter step at this level. We blew past 2.618. We almost almost wicked up all the way here to 361, which I do believe purple is above whatever that standard is that I previously mentioned. That I feel like this is like elastic, just way rubber banded past. So what I thought was interesting looking at this though was that strangle you were talking about, was talking about, what you had 160 strike on the downside.
Yeah, 160 was kind of my break even on the downside. So won't lose money down to 160.
Yeah. So, I mean, that at least, correlates to the action we see in relation to this Fibonacci extension where there was movement and a reaction around this level, which happens to be right smack dab there on the 160, which I thought was interesting. Purely from a PA perspective, this 2618, we just flew through there. So I think a reasonable pullback is certainly through this 205 when we're in price discovery mode, because that's basically where we're at now. This big gap here left a whole bunch of price discovery on the table. So anyways, I thought that was interesting, and certainly mapped out interestingly to those numbers you saw, and kind of, I don't know, to me, I mean, when it works like this, kind of helps clear some of that fog of war.
Yeah, the one of the values I'll throw back out there. We just mentioned the theta that I'm always kind of targeting, and so one of the reasons I was looking for a higher dollar amount for an underlying when I was looking at the trades was it really will help amplify the premium that you collect, and so that trade going out to the third week in July has a daily theta of about 40. So when I'm looking at my and a delta neutrality, so delta neutral, so no directional risk, theta of about $40 a day, and where I'm trying to target my portfolio is 75, and so if I can pick up a play that's going to give me 40 a day, that's a good play that I want to enter, and then it's further validated by the chart. Actually, even furthermore so by the interesting hard hat experiment with the Fibonacci sequence. And so, I thought I'd throw that trade out there for SMCI as it's likely one that I'll probably take in the coming days. So that brings us to the end of this week's episode. A little bit of look there on some of these recent earnings in CRM Salesforce, and then a little bit of a discussion there on artificial intelligence, and specifically seeking out artificial intelligence premium selling plays with SMCI, where you can really kind of see the power of that theta and the potential of that theta decay. And, just my line of thinking of when we're approaching these all-time highs, I initially didn't like to sell a lot of options on all-time highs because I didn't really know what was going to happen, what was going to do. And I'm starting to get more comfortable with them when I make sure, because what happens is in those all-time highs, you really get this call side bias that I talked about. And the premium side on the call side is really, really high. And it's high because it's got a little bit of risk to it. But if you kind of can look at some other factors and put some different protections to effectively short the stock up there by selling a call, and then having some sort of either buy a protection leg if you really want to define your risk, or also pick up a secondary side of that trade by the put side. I think there's good opportunities that can be had if you're very selective, looking for the 90th percentile of IV, an IV rank of above 60, 70. I just think if you're really, really selective, I won't say there's tons of these trades all the time. In fact, I've kind of been screening for these, and I haven't seen anything this good jump out in the past couple weeks. But this one, it was just there. Actually, I took a round on SMCI about a month or two ago, similar strategy. It was really stretched to the upside, and I took a strangle on it. I got 50% of my profit. I closed it out. It was a wonderful trade. You can check it out on thetagang.com/sprocket888. But just to give you something to think about, some ways to approach this where it looks kind of really scary, or you look like you might have missed the boat on profiting on something like this, but there still is profit to be had because there are still trades to be made, and there's lots of tools out there that you're available to you. So hopefully we were able to highlight a few of them there. We got some interesting stuff in the market all the time. Debt ceiling vote is coming up. Actually, it's happening right now as we're recording. So in the coming days, we'll see how that goes through the Senate. What does that mean for the markets? Is there any sort of default? How much volatility does that bring in? My guess is it's going to be a big nothing burger. And then everybody's going to quickly shift their attention back to the Fed, back to interest rates, back to all the stuff they were paying attention to before the squirrel went through on the debt ceiling. But good luck out there. I hope you find things that excite you to trade and you're interested in, and you're able to find your own trading style. And remember, think outside the block.